So having looked at the activity ratios, let us now move forward and look at the other classification of ratios that was called as liquidity ratios. So liquidity ratios were nothing but they measure the short-term payment capabilities of the firm. So there are short-term obligations which are defined as current liabilities. So liquidity ratios essentially check whether the company will be able to fulfill its short-term obligations. So earlier we have discussed a couple of liquidity ratios. They were namely current ratio, CR, and then we had also discussed quick ratio, and we had also discussed cash ratios. So we'll try and calculate each one of these ratios one by one. So let's start with the current ratio. What was current ratio? Current ratio was nothing but current assets divided by current liabilities. So let us take an example here. We have 2 years, 2006 and 2007. So we'll calculate ratios for both the years. So here the current asset is 250 and the current liability is 300. In 2007 we have this as 370 and the current liability being 300. So let's calculate this for both the years, 2006 and 2007. So these are 250 was the current asset and divided by 300, and likewise here we have 370 divided by 300. So these numbers come out to be 0.83 here and this is 1.23 here. So what we note is that in year 2006 current assets were actually less than current liabilities. So the firm was actually facing liquidity issues or liquidity crisis. However, when we talk about 2007, current assets here were greater than current liabilities, and we can say that this is a desirable situation to be in. So a further thing that we had understood last when we were looking at current ratios was to understand the bifurcation of current assets. So majority of your current assets may be in the form of the most illiquid asset, maybe something like inventory. So we need to kind of top up this ratio and look at another ratio so which can provide us with a deeper understanding of the liquidity. So let's move on and look at another conservative measure which we had earlier discussed. This was called as quick ratio. How did we define quick ratio? Quick ratio was defined as cash plus marketable securities plus your receivables. Here we have not included inventory because inventories are the most illiquid among this class, as inventories will be processed in the form of finished products and then will be sold to take the shape of receivables. So they come below receivables, and in the denominator we have this as current liabilities. So let us go back and see how this formula will work out. So here we have cash as 50 and accounts receivables as 150 for 2006. So this comes out to be 200, and for 2007 this is 100 plus 200, that is 300. Please note that we don't have marketable securities here, so we will consider only these two. So on the denominator side the current liability will still remain the same. It is 300 and 300 for both the cases. So for year 2006 this is 200 by 300, and for 2007 this is 300 by 300. So let me write this formula for 2006 and 2007. Formula here is 200 by 300. These are the quick ratios. This comes out to be 0.67, and for 2007 it is 300 by 300. So this comes out to be 1.0. So as we can clearly see that the quick ratio for 2007 is much better than quick ratio for 2006. So the company is actually undergoing an improvement in terms of liquidity measures. So on one side we have seen that quick ratio was another conservative measure of liquidity. There was in fact the most conservative measure which we have earlier discussed. We had earlier called this as cash ratio. So we'll calculate the most conservative measure which is called as cash ratio. This is defined as cash plus your marketable securities divided by your current liabilities. So let's calculate cash divided by marketable securities for this company for both the years. Here we have cash as 50 and cash as 100 for 2007, and the denominator still remains the same, that is 300. So going back quickly, this is cash ratio. This would be 50 divided by 300, so this is 1/6, so this would come out to 0.16. And for 2007 it is 100 divided by 300, so this is 1/3, 0.33. So obviously this cash ratio is better for 2007 as compared to 2006. So here we have noted that this company was facing some kind of issues in the year of 2006,